Michael Hewson of CMC Markets joins us right now on the show. Michael, good having you. Thanks much for joining in. Good morning to you, and thanks for speaking to us at Bloomberg Quint, India. I think.
Good morning.
I think it probably didn't catch too many people by surprise, but I'm wondering if you reckon from the commentary that the Fed has given, not just yesterday but in the recent past as well, about they being more amenable to support markets, financial markets as and when needed, and yesterday seemed to be a reiteration of the same, that there is enough gunpowder that the equity markets or the money markets would have over the course of the next 6 months of 2019, wherein the Fed would come and rescue if there is a dire situation.
Well, yeah, I think this is the key point. I think it's no surprise that the Fed dropped its patient language from the previous statement. I think the big question here is actually what's happening here. Is the Fed driving events or is the market driving events? And at the moment, I think it's very much a case of the tail wagging the dog, because while the Fed was particularly dovish, what they didn't do was significantly change their growth forecasts. What they did was they actually downgraded their inflation forecast. So they are predicting a little bit of a slowdown, but certainly I think not the type of slowdown that bond markets are currently pricing in. If you think about where we were at the beginning of this year, the consensus view was that we would see 2 to 3 rate hikes this year. Now we're talking about 2 to 3 rate cuts. That's a significant turnaround. When you look at a US economy that's still got unemployment at a 50-year low, wage growth is trending at around about 3%, and yes, inflation is falling moderately, but I wouldn't say it's falling off a cliff, and yet markets are pricing in the prospect of a rate cut next month, a rate cut in September, and potentially one in December. And that's before we even talk about the fact that the Fed is still paring down its balance sheet, and that's not due to end until September. So I think the market, the bond market, is getting a little bit ahead of events. And I think that's where we are at the moment. I'm a bit concerned that we could be vulnerable to a little bit of a pullback, particularly in bond markets.
Mm-hmm. Okay. There is an interesting correlation of asset class movements right now happening, Michael. Gold is at multi-year highs, 5-year highs in India as well, but multi-year highs generally. There is uptick in the equity markets or risk assets by and large. And while you spoke about a pullback in the bond markets for now, across, they seem to be on the trajectory upwards. What will give way first?
Yeah, I think it really depends on where gold finishes this week. At the moment, it's at a 5.5-year high. There is a big resistance level around about 1380, 1385. I would be surprised if gold goes much higher from here in the short term. That's not to say that I don't think it can go there in the long term. I certainly think we have shifted gears this week or this past 2 weeks in terms of inflation expectations, particularly in the euro area, particularly in Japan and particularly in China. I don't think there's any question that inflation is a concern and could actually drift back lower. But it's in pockets. If you look at the Canadian inflation data yesterday, that suggests that inflation is picking up. Here in the UK, it's similar. So you've got a little bit of divergence. I'm not convinced at this moment in time that we could see significantly lower rates of inflation in the short to medium term. That's not to say we won't get it in a year's time. I just think at the moment, bond markets are getting slightly ahead of itself. You're getting a little bit of capital flow into safer havens, but I think that's just a symptom of the market hedging its bets a little bit ahead of the year end.
Michael, I think the focus will now shift to the G20 summit. There was heavy pessimism, still continues in the market because of trade war tension. Now, with both the sides meeting at the summit, do you expect any sort of resolution to come by?
I don't expect any sort of resolution from this G20 summit. What is encouraging is that China and the US are talking to each other again. And I think that has to be taken at face value. But do I think we'll get a resolution? I don't. I think we'll get an agreement to continue talks. But as for a speedy resolution, I think that's highly unlikely.
So let's say, talk about a scenario if there is no resolution which comes by, then do you expect the next rate cut to come in the next month, or will it be in the month of September?
I think, for me, I think July is unlikely. Why do I think that? I think because the Fed is still reducing the size of its balance sheet. It would make no sense to me whatsoever for the Fed to be tightening its balance sheet while at the same time reducing rates. They can't do both. So I think the balance sheet reduction is due to end in September. You could signal in July that you're going to stop that and potentially signal a September rate cut. But I think July is mispriced.
Okay, Michael, the central banks around the globe seems to be on easing mode. In light of that, do you think that would benefit emerging markets? More flows could come into EM basket as opposed to the developed world?
I certainly think that's the case. You may recall a year ago that the rise in the dollar was really hurting emerging market growth. I think the flip side of that argument is a weaker dollar will help in that regard, and I certainly think there is scope for the Sensex index to retest that 40,000 level, potentially go higher, particularly if the dollar continues to weaken and interest rates remain around about their current levels.
Is India the most favoured market in the EM basket for you all?
Emerging markets is not really an area that I look at, but certainly in terms, I would follow the trend, and certainly in terms of the Sensex, the trend is very much towards the upside. So I would certainly look to buy dips on the Sensex. That's one particular area of the market that I do like. And I would look at that 40,000 level. If we crack through that, then we could go quite a bit higher.
Final question, Michael, from my end at least. Would you believe that aside of individual preferences that people may have on India because of the growth, etc., the EM dedicated money flows over the period of the next 6 months, if Fed is a lot more benign, would heighten in the region, and that might serve as a other leg for the markets to move higher, regional markets like India to move higher?
I'm sorry, I didn't quite catch that. I think the sound broke up and I wasn't quite sure of the tone of the question.
Okay, Michael, I'm asking if you believe that EM dedicated flows to markets like India and the other regional markets would only move up in the next 6 months if the Fed is going to be benign.
I certainly think that's the case. At the end of the day, I would always follow the money, and I certainly think a lower interest rate environment, particularly out of the US, would benefit emerging markets. I see no reason to change that view. That is the prevailing trend at the moment.
Okay, Michael, we'll leave it at that. Thanks much for taking the time out and being with us today at Bloomberg India.